Welcome everyone to a live webinar with Admiral Markets. My name is Chris. Today focus is on entry tactics within the market structure. I think it's going to be very interesting. Market structure gives us basically is the concept of understanding what's going on in the market, what's going on with price patterns, the price structure trends, rather than focusing only on signals, only on setups, but trying to go further and beyond what is obvious and try to think about the psychology of the market. So we're going to talk about entry tactics, though, how to actually enter the market within deeper analysis. So analysis is one part, the entry is a second, and we're going to talk about the combination of both in this webinar. Before we do that, though, be aware that this webinar is shown to a global audience, but may not be suitable for everyone. Please visit admiralmarketsglobal.com, select your country of residence, and contact the appropriate entity for more details if it is suitable for you. Please also be aware that trading for exchange and global financial markets is considered high risk. Please seek the advice of an independent financial advisor for more information on that. This webinar is for informational and educational purposes only. By continuing watching this webinar, you agree with this disclaimer and you are aware of the risk involved when trading. All right, so this time around, Nenad will not join us. I'll be taking a look at entry tactics by myself, but next time, of course, we'll be back together looking at the next topic in a duo. Today, I want to talk about, first of all, very quickly, what the market structure is, how we perceive it, how we analyze it. This is something that we've already talked about in previous webinars, so I'll try to keep it a bit short. But if you have any questions, of course, feel free to use the chat and reach out and let me know. Basically, market structure is a combination, is three things in our view, at least. The triangle of analysis is basically based on trend, support and resistance, and patterns. So trend is something, of course, that shows the direction. Trend and impulse, basically. The trend is something that where price is systematically going into up or down. If it goes sideways, that is not a trend. Sideways is a range, okay? The trend can never go sideways. If it is going sideways, it's a consolidation or a range. So the market is either ranging or trending, and within a trend or within a range, you have impulse and correction. So there could be fast parts within the trend, there could be slower parts. There could be fast parts and slower parts within a range as well. Support and resistance, pretty clear what that is probably, but that's where price has basically, it is bumping into levels that it cannot break. It is support or resistance, right? If it's retracing downwards, it could run into a bottom, which is support. Or if it's going up, it could run into a top, which is resistance. And then you have patterns, which are basically, there could be chart patterns, wave patterns, anything that has a repetition in the past, we can use as something that could give us an idea in the future. Of course, we have to be aware that some patterns are not so useful. Not everything is something of a signal. We've got signals, we have a lot of noise. So some patterns are useful, some patterns might not be useful. That's for us to distinguish. Chart patterns have proven their value if you know how to use candlesticks with them. Wave patterns are good for analysis purposes. Candlestick patterns are great for actual trading decisions like entries, for instance. So some patterns, are going to be valuable in different ways. Some patterns are going to be noise. For instance, if you have analyzed the last 2 months that every Monday at 11 a.m., the first 5-minute bar on the dollar yen has been bullish. That's a pattern that's probably not going to last. It's probably coincidence. Most likely it's not a pattern that is going to be sustainable. It's not going to have value, I think, in the future. So that's a pattern that's going to be, let's say, noise. Most likely we can mark it as noise. Okay? So that's basically the things we look at. Now on the left you see the market heat map of Admiral Markets website, admiralmarkets.com, and that shows you patterns about volatility, for instance. It's an easy overview of what kind of momentum can be found or impulse can be found on which currency pairs. So that's a pretty useful tool for looking at the market structure too. So you don't have to only look at the chart. You don't have to only look at indicators. You can also use a tool like this, for instance. On the right, we see a correlation matrix, and that's part of the MetaTrader 4 Supreme Edition. And that's also a useful tool about understanding trend, which currency pairs might be interesting to trade or not. You know, if you're in the euro dollar, does it make sense to trade the dollar yen? If they're strongly correlated, probably not, right? Depending on your risk management too. Okay? So let's continue. Let's give a bit more examples here. Basically, I already talked about it. The trend is or the direction is a combination of trend, momentum, and correction. So let me take a drawing tool quickly and show you what I mean with that very quickly. So basically, trend is, you can use a channel, for instance, to indicate what the trend is, right? Trend channel, very famous, or moving averages are useful too for explaining the trend. Let me show you right now. All right, so hang on. There you go. So I hope you see it now. So for instance, a channel like this, at the bottom, those green lines, that's a trend channel. Within the trend channel, price could go like this: up, sideways, up, sideways. So those blue lines are momentum, right? Those red lines are correction. But all four parts together are a trend or a trend channel with lower highs, higher lows, and higher highs. So momentum and correction, as they kind of follow each other, one follows the other, you can basically make a channel like this, and that will indicate the trend. So momentum and correction are part of the trend. The trend often has multiple pieces within it. If price is going sideways, this is an uptrend, of course. If price is going sideways, then it's no trend. It's not a trending environment. It's a range. But still, price could make quick ups and downs. Quick down, quick up, slow down, slow up, quick down. So you can see that here we have momentum and correction too, but within a range. Okay, so that's direction. That's all market structure, very quickly explained. Support and resistance, I used Admiral Market Keltner band as you probably know, Admiral Market pivot points, tops and bottoms, patterns, I already talked about it, so I won't dive into that again too long. So some key concepts before we talk about entries. Basically, to keep it simple, I use a 144 EMA close for the uptrend very often, or strong candles that indicate an uptrend on a higher time frame, like a daily candle. If this were a daily candle, for instance, in the purple box with a moving average like that, that would signal often strong momentum candle basically, and strong continuation, right? So that's direction. This is how you can analyze a chart like this, right? Moving average is up, is green, is up in this case. So perfect. That's price is above it. So we're in an uptrend. It is possible to look at it that simple. You can add support and resistance analysis by saying, okay, for instance, here we have a triangle pattern. That's a pattern, right? And we broke the triangle. So we have an uptrend, check. We have a pattern, and we have a break of the resistance of the pattern, right? So, or we have a bounce at support right here. So these are all ways to analyze the market. For more basically examples, live examples, pre-fact examples, methods how I analyze the charts, I recommend taking a look at a Tuesday or Wednesday webinar with me on Admiral Markets when we take a look at the market live. There are plenty of pairs we look at on a daily basis. So, I'm just giving you a quick example of how how analysis could be done. But this is basically discretionary analysis, where you use these three things to dissect the market day by day and understand which currency pair is interesting, perhaps, which ones have the most potential, set up a trading plan for those, and then basically execute the trading plan. So the setting up the trading plan is based on three things: trend, support, resistance, and patterns. This is just a quick example how that could be possible. So this could be a bounce trade, this could be a breakout trade, here could be a breakout trade on a lower time frame, perhaps where the blue circle is. That's a very quick kind of way, but just to give you an idea. For more examples, just take a look at the live webinar Tuesday, Wednesdays. Every time we're looking pre-fact at the market, and so you'll have plenty of examples there. Now, trading that analysis, I think, is how to trade that analysis. That's the next question, basically. So confluence, decision zones, and a trigger. So often enough, I analyze and then I say, okay, I'm waiting for this to happen. I'm waiting for price to break. I'm waiting for price to retrace. And then I want to see this or that happen. And then I talk about entry, stop loss, target, right? So these things, the confluence and decision zones, depend a bit on the structure of the market, right? So for instance, maybe we have a fib from here to here, and there's a Keltner and a 38.2 fib. That's confluence. This is a decision zone. So that helps aid my analysis that I'm waiting for some trigger at that, like a candlestick pattern, right? It's like this engulfing twin right there. That could be a trigger, okay? So that's the analysis part. Confluence, decision zones, and triggers are basically the second step. And then the next step would be what kind of entry tactics. Before I dive into that, though, things I use are bounce and break spots. Those are decision spots, break, pullback, continuation, point and confluence, and multiple time frames. So those are very important concepts in my opinion. Multiple time frames to gauge, understand the larger structure, the daily chart, very important to understand where's support and resistance. 4-hour chart, very important for patterns. Also to understand the trend and where there's confluence and where there's decision zones. And then, you can zoom in for some bounce and breaks, pullbacks, and continuations. For instance, here you can see there was a break right here, and we had another pattern. So this could be a classical break, pullback, and continuation, as you can see, right? So there are different ways of trading that. One could be to trade the pullback, for instance, like this, or wait for the second breakout. So those are all ways, but these concepts are just kind of ideas you want to keep in mind when analyzing. All right, so once the analysis is done, this will take, if you're starting out, this will take some time to gain enough confidence in your analysis. But once you have a feeling for that, or you think that you gain enough experience, it's time to look at entry tactics. How do you, once you kind of dissect the market, how do you actually make the entry, right? Because you might have analyzed it properly, that the trend is up, there's a pattern going on, you're expecting price to bounce at support. But if you don't have any tactics, any methods to enter, everything could slip by before you know it, and your analysis was spot on, but the trade was not entered. So what I use for that, and there are of course plenty of systems out there that only look at entry tactics, but what I use is candlesticks, fractals, Fibonacci, time patterns. Most of my entries are based on these four things. All right. Now the difference with just a system is that I do the analysis first. So I want to emphasize that. I analyze it first, and then I look at entry tactics. Not I look at entry tactics and then I analyze, or I look at the entries and I don't analyze. First analysis, then I use these tactics. All right, so that's the difference basically I'm trying to find a signal within the noise that has the highest probability, the best chances. So I'm trying to filter out the noise first. So let's talk about these four things now. Candlesticks, I think, are one of my absolute favorites because they're such a high level of information, such a good quality of information. Candlesticks really give the buying and the selling pressure, give you information about who's in control, bears, bulls, or nobody, and therefore give great indication about breakouts and bounces. So candlestick strength indicates breakout potential. So when a candlestick, as you see me drawing here, one second. Now you should see me drawing, sorry. Let's make it green. All right, so a candlestick like this, breaking through, for instance, a trend line like that, all right, like this, okay? A candlestick like that is a strong example of a breakout because it's a decent size, and decent size is relative to the time frame. On a 4-hour chart, 40, 50 pips is probably a decent size candle. So you can just easily scan the previous candles and see if this current candle is average or bigger, then that's fine. If it's smaller, then that's not a good breakout candle. So if it's a good size, average or bigger, if the candle close is within 0 to 25%, I mean the best is 0 to 10, then 10 to 20 is good, 20 to 30 is okay, and more than 30 is question mark. And I'm talking about this little small wick, that wick right there at the top in a bullish breakout, or of course the wick at the bottom in the bearish breakout. If the candle is closing near the high or the low, then that's good. Within 20, max 30%, then the bulls or bears are in control. And that's a strong breakout candle. So that indicates strength. So that is basically one way of looking at entries. Waiting for basically the candle to confirm whether the market is ready for breakout or is it a false breakout. With bounce trades, the opposite is true. For instance, if price is moving lower, back down to support, all right, if there's a lot of confluence at support, I might take a pending order. But the opposite could be interesting too, is to look for a pending order, a market order, as price makes some engulfing twins like this, for instance, right? Or if there's a weakness, candle weakness, for instance, right? That could also indicate bounce. So for instance, bearish candles, and all of a sudden, there's a big wick, and there's a pin bar like this, right? That wick at the bottom is indicating candle weakness. That's a bounce trade that could indicate a reversal. So for me, looking for candlesticks at bounce, at decision zones, first analyze, look for decision zones, wait for triggers, wait for candlestick weakness or strength to confirm my trade idea. For me, that's just the best, one of the best ways to look for entries. Or candlestick patterns, thirdly. Engulfing twins at the zone of interest. Other things I look for, break of fractals, but I look for them on lower time frames. For instance, on the daily chart, I could be looking for support or resistance. I like to use 3 time frames, by the way. 3 time frames I think is ideal. 4-hour chart, trend, momentum, patterns. 1-hour chart, I could be looking for break of fractals. So for instance, here on the daily chart, there's resistance. On the 4-hour chart, I see an uptrend followed by a triangle, right? And the hourly chart, I'm looking for a break of the fractal for continuation up to the daily resistance, if there's enough space between those 2 levels, indicated by the blue circle, right? So the break of that fractal could be another way. take the trade to the upside. Or I could take the break of the fractal, not immediately, but wait for a candle to break through that fractal. So I'm looking for a combination of candlesticks and fractals, right? That could be another way. Next on the list, Fibonacci. Fibonacci is great, especially within trends. Buy the dips, sell the rallies. It's great. So if you have a downtrend like this, and you see price, for instance, going back to the 50 fib, you put a fib from here to here, and you see that it's retracing back into this zone, then that could be a great entry. But here too, we could also wait for candlesticks at the fib levels. So I could trade at the fib, or I can wait for a candlestick at the fib, or I can even wait for a downside up, move to the 50 fib, right? And I might not even take the fib, but I might wait for the turn. I might wait for a new fractal here, wait for a bounce, and then take the fractal break after hitting the fib. All right, so there are a lot of options. You can mix them as you want. That's why I like they're fluid kind of concepts, and you can take it, combine these things. Now, not always will this fractal, of course, exist, but typically it will on a higher time frame. For instance, if I'm looking for a 50 fib on the weekly chart, I typically wouldn't trade that. But on the hourly chart, there could be a fractal there, and I might trade the continuation after price turns at the 50 fib on the weekly chart. Why would I wait for the turn? Because on the weekly chart, a turn at the 50 fib takes time, right? We're looking at a ship, basically. Just picture a huge, massive container ship that is approaching a port. It doesn't turn quickly, right? It needs time to turn, right? So there's plenty of time for us to basically prepare when looking at time frames like that. So there's no rush with that. Also, keep in mind that if it's a weekly chart, that if you're looking at a 50 fib retracement, that easily price could still push 50, 70, 100 pips beyond that 50 fib before turning. The markets, the fibs work pretty precise in the markets. But when you're looking at such a high time frame, be aware that the 20, 30 pip break above or below a fib level like that could easily occur. Just because the 50 fib is at, let's say on the euro dollar is at, I don't know, 120 or 110 nowadays, right? Doesn't mean it's going to stop at 110 exactly. It could be 110.50, and it's still considered a 50 pip bounce on a weekly chart at least, because the 61.8 fib could be at 113. Time patterns. That's a bit more complicated. For those that join my webinars, trading webinars, you know this pattern. So we'll talk about it, but I'll use some charts for that. Let's take a look here. So, for instance, your dollar daily chart here. Just to give you an example, you can see that, okay, here we analyze resistance is here. We analyze uptrend. We have a strong candle right there, strong master candle on the daily chart. Okay, so we have a channel up. Resistance is still far away. And patterns, we see perhaps an ABC zigzag pattern, for instance, like this, A, B, C. Otherwise, at this moment, I don't see any patterns. We definitely see some weakness here. I don't see any other patterns at this moment. So the daily chart is telling us that a buy is interesting, right? So if we're a daily chart trader, it might be worth it to trade right away. But most likely, people, you now looking at this webinar or the video, and we're looking at a bit lower time frames, maybe the 4-hour chart or the 1 hour 15. But this would indicate that my focus for that day would be up. Okay, so, and you see a little bit of a retracement here the next day. So on the hourly chart, for instance, there could be some correction like that. a bull flag, and I could look for a bull flag break as an entry to catch part of this upside here. By the way, here you see another example. You can see, for instance, here the time fracture pattern explained. So I'll dive into that now. So for instance, here you see that I was looking for a bounce. You can see that price was making a downtrend. There was reasons for me to look for a reversal, reasons for me to buy. And I was looking basically for a push, hook back, and continuation. All right. Now I took it a bit higher. I missed that turn when I actually wanted to take the trade at the purple box. I missed that spot, so when I looked at the chart, that's where price was, so I took it a bit higher, as you can see. But time factor basically indicates that when 6 candles do not break a low, that particular piece, that particular swing is finished. So when there were 5 to 6 candles here that didn't break this low where there's the blue arrow, this particular swing was finished most likely. That means that there was divergence between these bottoms. That means that this swing was most likely finished. I think there was probably some support level here as well. So that was another reason why I was expecting a reversal. So as 5 to 6 candles didn't break this low, there was a good chance, in my opinion, that this was over and we might see a reversal. We might see weakness here. That's what happened. We didn't have a lower low. We had a failure to break this bottom. And you see a rally indeed occurring. Now I waited all the way here to exit that trade. As I was looking for basically higher time frames, I expected a further push up. All right. So you can see that there was first an ABC zigzag, and then there was a bull flag. And I used the same rule, time factor rule, to exit there. Now the reason why I didn't use the time factor rule here at the blue circles was because I was aiming for a higher target on a higher time frame. And another thing that I had in mind that played a role was the fact that we had 5 waves up here. There was an ABC pattern, so I wasn't scared of this correction. Also, I wasn't scared of this correction because this was a bull flag. But I wanted to get out here because there was divergence between these tops, and I had hit the higher target that I had in mind. And so that was basically the main reason. I had hit the higher target. There was divergence on this time frame, and anything else? Those 2 were the main reasons, I think. Plus, I already survived 2 corrections. So what I did then was that as price topped out here, I waited 5 to 6 candles for this high not to be broken. So for me, that indicated that there was a higher chance of a retracement. So I exited here at the purple box, and indeed, we got a bigger retracement. After that, we still had one more push up, or perhaps more, I don't know. But in any case, that was my plan, and I just executed the plan. So if it continued higher, that's fine. Actually, it started to make some kind of channel like this, but that's okay. I had that target in mind, so that's fine. Anyhow, I could always still rejoin if I wanted to later on. All right, so those were the examples I had prepared. I'll take a look at some live markets now. Do you have any preference to take a look at any currency pairs at this moment? But basically, these are my main things. Candlesticks, fractals, Fibonacci time pattern, and a combination of these. So for instance, often fibs and time patterns go well together too. Why? Because for instance, here you can see as 5 to 6 candles don't break this bottom, right here, don't break this bottom, then I put a fib from the top to the bottom and wait for a small retracement there. So that's how they can nicely go hand in hand, right? Now, not always does it happen. Sometimes you get a downside like this and you get a pretty aggressive upside like that. That's like a V-valley reversal, right? You can see the shape like this, right? So in that case, you're not going to get the hook back. So it's something you got to be aware of. Sometimes it works, sometimes it doesn't. So if you have a move down like this and you got a correction like that, that fee valley, right? 5 to 6 candles, you might enter somewhere here. So the time factor pattern, you will get the entry, right? But you wouldn't get the fib entry. Sometimes it works like this. You get a down move, you get an up move, you get a time factor pattern kicks in, you get a weakness, and then you get an up move like that. In that case, the fib works great to put the fib on this leg and wait for a retracement here. Then the fib and the time factor pattern work nicely in tandem with each other. That often happens, I think that happens often when you have some divergence like this, 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 and then you get this, and you get often a head and shoulders pattern, for instance, right? So when you have divergence, you typically get the hook back. If price is falling very quickly like this, sometimes you get that V-valley rally, especially if there's on the lower time frame and you got big support level here. It could be, you know, that reversal could be swift, could be quick, and you might not get the hook back. So that could happen, especially on lower time frames, especially if there's strong support, especially or resistance, right? If there's strong support resistance, and especially if this lower time frame is retracing within a trend. So if this is a 5-minute chart and the trend is up on a 4-hour chart or hourly chart, and the 5-minute is retracing back like this, then the V-valley often occurs, you know, could occur quicker. So keep that in mind. You know, fibs work great with time factor, but sometimes with these patterns, it wouldn't be available. All right, let's take a look at the live charts. Hang on, let me pull that up. 1 second. So we got DAX and pound dollar mentioned. We're going to take a look at those two right now. For those that are interested in the MetaTrader 4 Supreme Edition, you can do that right here. You can download it, MT4 Supreme Edition, platforms, part of admirmarkets.com. You can get access to the indicator package, access to the Kelter bands, pivot points, a lot of other indicators like the mini charts and the mini terminal, trade terminal. Well, there are about 60 features, so I could keep on going for a while there. Pound dollar, let's take a look at that right now. Alrighty, so this was actually a good example. Pound dollar, we talked about it this week, for instance. I was talking about the breakout of this triangle, right? And I left it on. So you can see that this was a breakout candle, and it did retrace after that, but still continued later. Or the next breakout candle would have been this one, right here, right? This one. So let's skip the analysis part. If you're interested in the analysis part, you can always look at Tuesday's webinar. This week's Tuesday, that was Tuesday, 25th of April. But our analysis, or my analysis, I should say, was saying that I'm looking for a break of this consolidation for upside continuation. All right, so I was bullish. I'm looking for long setups. For me, I was looking for a candle that could break above this trend line. So for me, this could have been one, this could have been the second. Both were okay because both had average size candles. They were not big, but decent. They were not small, so that was enough to qualify. And the candle closes were near the high. Obviously, when we zoom in, this was not a good breakout candle. That was a false breakout candle. Wick on top, bearish close, definitely not a candle I want to trade a breakout of. So that was a no-no, clear no entry there. The other two had a green light for me, or a blue check mark. In both cases, the stop loss would have to go below the 50 or this bottom. all right? And the target, well, I said 129.30 up to 130. At that moment, that target is still open. Prices hit 129.18. But at this moment, you know, it depends. Either exiting now, there's a bit of a wick. Of course, there's a potential for double top. Aiming for the top is never something, bad if there's a wick like that. Or another option could be to move the stop loss just below these candle lows, for instance, right here. At least move to some profit. Lock in some profit there, or at least move to break even. I would lock in some time, lock in some profit. But that's trade management side of things. It's a different story. But these two are breakout candles. So these are candlesticks in relationship to trend lines. I didn't even mention trend lines in my PowerPoint, but that too counts. If we would have had fractals, let's add fractals quickly. Like here, for instance. Let's see. There could have been the multiple entries. One of them could have been, for instance, waiting for a bounce. We see here a fractal, so that could be support. We see the fractal at the 38.2 fibs, so we're combining fractals and fibs. So could be looking for a bullish reaction to this 38.2 fib. That could have been this bullish candle, or we could be waiting for a reaction to the fractal and the 38 fib. That could have been this candle as well, the same candle, or this one. Those are the same candles, in fact. Right? So there's confluence there. If we're waiting for a breakout of the fractals themselves, then in that case, we have to put a trend line like this. And, well, that would have taken some time. That would have been probably this one or this one. That does not look that interesting because of the fact that resistance is pretty close by, but it would have been this one or this one. And that trade is still open. Right? Those are breakouts. But that's on this time frame. Of course, we can zoom into a lower time frame. You can combine those time frames. 4-hour chart could be the analysis. On the 1-hour chart, we can look for entries, for instance, right? So on the hourly chart, I could be looking for a breakout of this trend line, right? But, sorry, on the 4-hour chart, I can be looking for a breakout, but on the hourly chart, I can try to do the entry. So I can see a fractal and a trend line. So the breakout candle on the hourly chart could be this one right here. There's a good candle right there, decent candle, about 30% wick, so it's okay, decent size candle, and it's above that trend line. So this could be the entry, the trigger, the entry candle on the hourly chart, for instance. We could use break pullback continuation concept on the hourly chart. So this could have been one entry, but if we missed that, we can put a fib from here to here and look for a bounce at these fibs. What would entail a bounce? This candle. This looks like a bounce. A wick at the bottom and a bullish close at the 5061.8 fib. So we got a pattern here as well, but more importantly, a bullish candle at those fibs, right? So another entry candle. Now in this case, a candlestick at a fib instead. Here we had a candle breaking resistance, breaking the trend line and a fractal, basically. Right? So these are some examples of the pound dollar, which we discussed pre-fact, the analytical part, and also how I would trade it. And here are some examples on the 4-hour chart and the hourly chart of trading breaks and bounces within that market structure. So we analyze the pound dollar, and once again, if you're interested in the analysis, take a look at the recording. You can find it on YouTube. But we were bullish. I was looking for longs, and then the next step is how. These are a couple of examples. These two 4-hour candles, because of the breakouts and the bounces, basically, and the hourly candles here because of the breaks and bounces again. Breaks of trend lines, bounces at fibs, etc. Looking at time factor pattern, right? The entry would have been here, 1, 2, 3, 4, 5, fifth candle, 5 to 6 candles. A bullish candle like that is a pretty good signal. The sixth candle itself Could have been one, but there's a difference here. Look, the sixth candle is already basically putting price right at the Keltner. So in that case, you want to be careful not to enter right at the Keltner like this. In this case, the sixth candle right here could be an entry, could be worth an entry as well. And it did work out, but you might want to consider maybe even a small retracement first to retrace part of that candle before trading it. Now, you don't always have to do that, but it's something to think about. Let me say it this way. Right? So basically we have break, pullback, continuation, and within the continuation you have, again, break, pullback, continuation. Now these concepts, once again, are only valid, only used by myself if my analysis says that they make sense. So I first want to justify whether it's worth looking for a signal. If the chart I'm looking at is noise or noisy, then I don't even look at entry tactics. Entry tactics only, of course, come into play, come into focus when the analysis has a green light. If these entry tactics are used at every spot, who knows how they will work out. They're not meant to be, used at all times. That's not how I use it, at least. All right. So now, if we look at the pound now, would I use it now, right now? No, because my analysis would say, look, price is at resistance. We're on an uptrend, we have bullish momentum, and we're breaking a consolidation pattern, excuse me, but price is right at resistance. And so far, the breakout candle is not showing strength. The breakout candle has a big wick. It's not a reversal candle. This is not a reversal candle, but it's not a breakout candle either. So I'm in a waiting mode at the moment. So I don't even have to look at entry tactics at this point because I don't want to enter either way. What would justify an entry at this point? I would probably need to see a daily chart break. I would probably need to see on the daily chart a daily candle that has a close above this resistance and has a close near the high. In that case, I would be interested in trading it to the upside, but I would zoom in tomorrow, look for some retracement of today's candle, and try to look for a continuation. Now tomorrow is Friday, so I might not even do that. But in theory, if it weren't for Friday, that would be the plan. Now tomorrow is a Friday, and it's a retracement day, so I don't think this plan is something that I would actually implement tomorrow. So I probably would not trade the pound anymore. This week, to be honest. But for me, the pound trade was at this spot, right? Somewhere in here, the retracement and continuation. Now it's, I think, too late in the week to still trade that continuation. But if it were not too late in the week, that's what I would be looking for, a daily candle that would be, something like this, strong close, breaking above that level, and continuing. That would give the green light to myself to trade the continuation. So maybe more example on, or here, one more example of time factor. Even on a 4-hour chart, right? 1, 2, 3, 4, 5, 6, 7 candles, not breaking this bottom. So even here, somewhere around here, it could be worth trading a bounce trade rather than waiting for the breakout. We already had a breakout candle, but here we see time factor pattern not breaking this low, plus price stopping at the 38.2 fib. So that could be one way of entering as well. That would have been one of the best entries, actually. around 127.80. So yeah, I think that's about it. So yeah, that's combining fibs. You see fibs, you see fractals, you see candles, and you see time factor. Yeah, one more thing, by the way. If I would be looking for a reversal in here, for instance, right? Let's say I would be looking for a reversal. Or the dollar yen. Excuse me. Wait, let me go back. Here, for instance, right? On the dollar yen, I was looking for, here I was looking for continuation. And here I was looking for price to top out a bit. There's resistance. There's a 4-hour candle like that. But 1 hour, from my point of view, this one candle was not enough. I was looking for one more candle to be bearish to indicate that there could be a reversal. So reversals, keep in mind, are often enough not succeeding. So you want to be very critical with reversals. You want to be very strict. You want to get extra confirmation if possible. So for me, here was buying time, breakout time, bounce time. Here was profit-taking time, but not yet reversal time, because I was looking for more candlestick confirmation. And that happened here with this strong candle. But that was already basically eating up most of the space I had in mind. So now we see a bit of a correction like this, and it is moving lower like that. Let's see how far it gets. But I'm not surprised that there's some kind of correction here. And then after this correction is over, I wouldn't be surprised if it builds a bull flag to see one more push up. So you see that analysis first, then looking for signals using those concepts on this time frame or lower time frames, right? What I wanted to basically emphasize here was that it's okay to be neutral, right? Anywhere around here, and here, neutral, right? This was the time to trade the break, to bounce, or the break of the bull flag, where the green circles are. This was the time to trade the break of the top. But the blue circles indicate times where it's fine to wait and not trade it either way. So the green circles indicate good moments for longs. Blue circles are waiting moments. And maybe the orange circle here, potential reversals. But you want to be always careful with that. Alrighty. Let's see. DAX. I don't remember. I'm thinking what we were saying. I'm not sure anymore, but we can take a look at some examples. I don't remember if this is pre-fact. Pound dollar was definitely pre-fact, but if you don't mind, let's just take a look at some post-fact examples, okay? Not to complicate things. I mean, we can analyze this basically if you want, but I want to give you some entry tactic examples rather than some pre-fact analysis. If you're interested in pre-fact analysis, once again, Tuesday, Wednesday webinars, do that. And then we look at the next day, what we said yesterday, and see how that played out. Try to learn from that, see what went well, see perhaps what didn't go well, sometimes, of course, as well. So I would encourage you to do that. But just to give you some idea about what we could be analyzing. So for instance, here on the daily chart, or weekly chart, we can see that resistance levels are here and here and here, for instance. All right, so all right. Let's go, I don't know. Let's go here when we're breaking through this resistance, right? So we're breaking through this resistance. We're in an uptrend. This could be, we're just simulating some analysis quickly. So we're in uptrend here. We could see, for instance, that we have higher lows like this. All right. So we're breaking above the resistance. The next resistance is very far away, as you can see. Oh, excuse me. Like this, breaking above it. And we were looking for a pullback and continuation. So on a 4-hour chart, we might put even a fib like this and looking for some reaction at those fibs, for instance, right? Now we have to add the context because, once again, this is discretionary. So what could we be looking for? 50 fib, if price bounce there, is perfect, right? There's nothing wrong, or the 38. So when we see price fall like this, obviously this candle's scary. So we're not going to trade that. I wouldn't put a pending order at the 50 fib with such a candle like that, right? Obviously not. Even the next candle, I would have some doubts. It is a bullish candle. Could be one way to trade. A very aggressive trader would actually take the 50 fib, but I would never trade against a candle like that personally. I'll be honest with you. This is definitely not something I would take. This bullish candle, I might think about it. Depends how confident I am of the upside. That could be an option, right? More likely, I would look in this case for time factor. So 5 to 6 candles not breaking low. 1, 2, 3, 4, 5. Somewhere in here, I know that this correction, this swing high, swing low is probably over. I could put a fib on this smaller side like this. So I put a fib on the smaller swing like this, right? And I see a 50, 61 put a hook back. So it could be an entry right there at the fib, a market order, a pending order, or wait for these engulfing twins like this, these bullish candles right there at the smaller fib. Candlesticks at the fibs after a bounce at the fib. All right, or even zoom into the hourly chart. Here we can see engulfing twins on hourly chart, engulfing twins on hourly chart, right? Also possible. Or even 5 to 6 candles on this time frame, somewhere in here. Or the break of fractals here. As price breaks through these fractals, we have the red line. That could be another way of trading the continuation, basically. So you see a lot of examples. You see time factor examples, fib examples, candlestick patterns, and break of fractals, and a combination of those. All right? But if price is getting, for instance, is moving away, we see like this, and price is already somewhere in here, right? Then in that case, it's good to wait. Or zoom into a 50-minute chart. One second, folks. Where was it? I was here, right? Yeah. All right, zoom into a 50-minute chart, for instance, right? If price has already moved away from the break, continued from the second breakout, for instance, so far, there's still chance to catch a part of it on a lower time frame sometimes. But of course, if it's really extended, then even you want to be careful with that. Now, how do you know it's extended? Divergence, of course, double divergences, strong resistance, clear SPY, an uptrend, stuff like that. You want to be careful, right? So things to look for are some patterns, for instance, on these time frames. We didn't have it here. I don't see any entry potential here, to be honest. So there was nothing there, in my opinion. But let's say price would have done this. Then the breakout of that could have been a good entry. So the first 2-3 times it's okay. If you get the fourth breakout potential or fifth, then typically those start to become weaker setups. So after a while, you want to zoom out again after a run like that and say, okay, I want to rather wait for a bigger retracement first before trading it again, because on the 50-minute chart, there's probably not much space left. So I hope that makes sense. Basically, trading the bounces here, trading the breaks are all good to go, makes sense in this case. But if you wait too long and price is all the way up in here and you got resistance close by, then it's a moment to wait rather than trade it. If you're down in here still, maybe on the lower time frame, right? On the hourly chart, the optimum moments, and 4-hour chart, optimum moments are here and here and here and here, right? And maybe here. On a 15-minute chart, they could still be found here because there's still enough space to resistance. But when we get closer to here, that's where we want to wait. Not yet reversals, but wait. Go neither way. Maybe in here, reversals, perhaps, if there's some reason to look for a bigger bounce. Right? If we break the top, perhaps look for continuation still here, right? And look for, on the lower time frame, look for that follow through. If there is some a pattern or formation, or you can still use the same concepts. Look for, on a 15-minute chart, look for some small bull flag after the break, and look for the break of that bull flag, for instance, etc. So this is how you can ultimately do discretionary analysis, look at the chart, multiple time frames preferably, analyze it, dissect it, understand it, choose the ones that make the most sense for you because they're trending, because they're ranging, find your niche. I've talked to one of the traders that I know well from all these webinars throughout the years, and he told me this week that he's been very consistent lately, and he doesn't actually use any indicators. He was using indicators, but it kind of clicked to him after Neneth. He said Neneth and I really showed him how he can dissect the market, and he's looking at trend, pullbacks, and then trading those continuations. And we do show indicators and tools, but if you do get the hang of it, a lot of things you don't really need that much, right? They're good shortcuts. This moving average is useful because you have a quick overview. But eventually you might not even need the moving average because you already know what the trend is just by looking at it. If you get enough experience, if you look at the charts enough, you can look at the chart and you intuitively know where the moving average is. You know where the 144 is without even seeing it. That will happen once you get more experience. So he said that he was very happy with his trading because he was able to analyze the market, wait for the signal, ignore the noise, wait for price to get into his zone, get into his area of interest, get into his decision zone, right? And then look for that entry. So let's say, exactly as we've been saying here, let's say that the 50 fib is our interest zone, right? So waiting patiently for that retracement, waiting for the reaction, and then try to strike in this zone, right? Try to take the entry in that zone. All within this uptrend. That's what basically is working well for him. And that's not going to work well for everyone. Discretionary analysis is not for everyone. But if you like it, and if you have the patience and the time to get the experience, I think that it's going to be a rewarding process, and also is going to make you robust in your trading and your analysis because you're going to be flexible as the market changes. The market has a different vibe. These things happen, right? Systems work well, then have their drawdowns. But if you can analyze a chart and understand the market structure, understand the psychology behind it, then you're going to be less vulnerable. You're going to be on your feet, always ready for the next, changes. You'll be able to analyze what is signal and you understand what is noise a lot better. And if you know that, then finding the entry tactic is going to be a lot more easier. It's going to be a lot easier, especially with these concepts, I think. So patience, wait for decision zones, do the analysis, wait for price to get into your zone, and then if price has, you've done your proper analysis, you've waited for price to get into decision zone, and you see the entry tactics line up for you in that zone, that's it. Three-step process: analysis, decision zone, entry tactics. All right, so that's what I wanted to share with you. Once again, if you're interested, MetaTrader 4 Supreme Edition, you can take a look at all the indicators I mentioned there. Of course, and more, 60 extra features. Webinars as well, Forex and CFD webinars you got lined up next week again. Analytics, fundamental technical analysis, you name it. IronMarkets.com, I hope will be your home for all of that. Vida is saying it sounds very easy. Yeah, it's often enough I have a feeling I try to explain things too complicated almost. Is I think one of the things that I bump into maybe. You're the better judge of that than I am. So I try to boil it down to really like what is the essential things. Obviously, of course, if you want to implement it, be patient with the process. It's going to take you some time to build that experience and feel comfortable with trading that. That's why it's good to demo trade, risk small, so you get accustomed to this process. And it's not going to be for everyone. If after months and months of trying, you still don't think it's for you, it's not something that everyone likes. The best time frames is something that you can manage. And you feel comfortable with. Some people are impatient with setups that take too long. Some are nervous if setups happen too fast. I recommend 3 time frames that are connected to each other and close to each other. So either monthly, weekly, daily, or weekly, daily, 4 hour, or daily 4 hour, 1 hour, or 4 hour, 1 hour, 15, or 1 hour, 15, 5. But if you do look at 1 hour, 15, 5, I would still recommend actually to perhaps look at the daily. Maybe the daily is always good to have. So perhaps daily 1 hour and 15, or daily 1 hour and 5. Because the daily chart, just even if you're intraday or scalping, it gives a lot of value. Where's support and resistance? Where are the daily highs and lows? What was yesterday's candle, etc. So analysis, I think, based on 3 time frames is great. You can look at all time frames, what I do too, but at the beginning that might be confusing. There is no limit really to analysis. It's up to you what you think is a good balance and doesn't make you confused, and what you can do efficiently and effectively. That's up to you. That's a different kind of webinar again as well. I wanted to, today's focus was more on the tactics that traders can use. And there are more of them, but these, I'm just saying the ones I use. So a stop loss is again a different webinar really, but basically using candle patterns, the lows and highs of those patterns, using candlesticks, the highs and lows of those, using fractals, using fibs, using the tops and bottoms of the fibs or the next fib level as well sometimes on higher time frames. Those are all options. So for instance here, right, if we're looking for, this is an hourly chart, remember, so if we're looking for a pullback here, for instance, it could be good to put the fib below this bottom, right? Because this is the swing high, swing low. We're looking for a move up. We consider this a pullback, and we're consider upside. So if it breaks through this bottom, it would invalidate the whole analysis. So a stop loss below that makes sense. But if we're looking for a breakout here, right there, then the stop loss below this bottom would make sense because we wouldn't expect the retracement that deep anymore. Or if we're on a 4-hour chart, right, and we have, that's basically the same thing. But if we're taking this 50 fib, it might make sense to put the stop loss below the 61.8 or even below this bottom if you're taking a pending order. But if you wait for a reaction to that level, or if you wait for a hook back here, then you can move it up to this bottom. Yeah, so those are some quick ideas there. All right, folks. So once again, if you're interested in discretionary analysis, take it step by step. It's a learning process, and don't get discouraged. It's especially, let's say, especially good if you're interested in as a hobby. If you really like looking at the charts, this is a great thing. Discretionary analysis then is very rewarding because you learn a lot and you improve like this. If you're looking for signals, if you're looking for setups, and you're not so interested in doing the analysis, then this is not so much for you. You could still think about the entry tactics, and keep that in mind, but you would still want to have some kind of system as a support. You still want to look for some system, and then you could maybe use these tactics as an extra, right? So think about it, what type of trader you want to be or think you are. That's important. And well, if you have any questions, of course, feel free to let me know. And that will wrap it up for today. Thanks for being here, and wish you all great trading. Cheers.